If you are here, you are invested 100% in the risk-free T-bills. If you are here, how are you invested if you're here? Okay, so you will be 100% invested in the market portfolio. Doesn't look very well written. The market portfolio represents something like a S&P 500 index, but actually all assets, all risky assets are in the market portfolio in some fraction. If it's 0.00, so it's very small, 0.000 something, at any rate, it's still in there. So that has all the risky assets in some fraction in there. And the fraction that it is determined by the selected one out of all the possible ones. In real life, investors, it's recommended and historically and by academia that investors invest in a diversified portfolio of risky assets as opposed to trying to pick stocks, right? The idea is that all of the work done to determine um, the right combination of securities has already been done by firms that have invested with the top staff and the top AI and all of that. They've done the work for you, and it's negligible the price that you'd have to pay to incorporate all the information they have. So investors are advised to invest if they're prepared to take risk, that they invest in the market portfolio or a fraction of it, right? Like they buy shares or buy a part of that index. So what you have here is a trade-off between return and risk as measured by the standard deviation of the portfolio. Investors could either be invested 100% in T-bills, 100% in the market portfolio, or in some combination of the two. If they are here, investors here are partly invested in T-bills and partly invested in the market portfolio. So for example, if they spend $100, then this could be $50 invested in the risk-free and $50 in M. Okay, so that's like 50-50. It's kind of in the middle there. How do we invest in B? How do we take this position? Who can explain it to me? Do you guys not know, or are you just shy? So all the options here involve loaning money to the government at the risk-free rate. In this model, like in other models, this is an abstraction of reality, and there's many assumptions that describe or create this model or uphold this model, okay? And one of them is that there is no other interest rate except the risk-free rate. And the risk-free rate is available to investors who want to loan money to the government. They get RF, 5%, 3%, as a return for loaning their money. But in this model that we're creating the foundation, these are the foundations of the capital asset pricing model. You can also use the interest rate available to borrow money. Okay, so the flip side of lending is you can actually borrow money using T-bills. And how do we borrow money using T-bills? Two words. Do you know the answer? You can short sell T-bills. You can short sell T-bills and use the proceeds of short selling by putting it towards the market portfolio. By doing so, you can extend the possible combination of expected return and risk. So if you're willing and um, your risk tolerance is higher or up to here, beyond, so you're even willing to take more risk than investing in the market portfolio, then you would have this expected return by short selling T-bills. That means borrowing the T-bills from a broker. We assume that arrangement is possible. And then borrowing them, selling them, using the proceeds and putting all that towards the market portfolio. That would give you this combination of expected return and risk as measured by the standard deviation of the portfolio. I described short selling here. I think we did it last class. You can tell me if not. And something like B, can you guys give me the percentages? So I said being here is 100% RF, 0% M. This position A is 50-50 RF and M. This position M is 100% in market portfolio, 0% in the risk-free. And what would be position B? Nobody? So position B would be something like borrowing 50% worth and investing 150% in the market portfolio. Okay? They add up to 100 and that puts you there. If you guys aren't asking me questions, I'm just going to move on. All right, so that is the foundation of the capital asset pricing model, but it begins with a discussion of the capital market line. The key assumption here is that investors can borrow and lend money at the risk-free rate. Now that's an easy one to explain as a difficult assumption to follow or swallow, because when you think about it, usually when you borrow money, your interest rate is higher than if you lend money, right? So just think about depositing money to the bank and borrowing money through a credit card associated with the bank. Your credit card interest rate is much higher than your return of deposits, like your interest rate on your deposited money to the bank. Much, much higher on credit cards. All right, but that's the assumption we make here, and the only interest rate that exists and that we operate with here is the T-bill rate. Let me see if this has 2 pages. No, that's okay. So that brings us to the capital asset pricing model. What we're going to do with the capital asset pricing model is, instead of return and risk measured by the expected return to the portfolio and the standard deviation, we develop this security market line instead, which is a line defined here, where all assets fall. all stocks, all bonds, and this line extends back and forward. All of them fall on this line, stocks and bonds and investment opportunities. They all fall on this line. This is also demonstrating the return and risk trade-off, whereby higher risk tolerance has a higher expected return. I think we ended last class where I asked you, what was the slope of this line? What was the slope of this line? No ideas? It is not beta, because beta is actually the horizontal axis. So if this is y, because that's on the vertical, this one is your y-intercept because it's right here. And this one is your variable x. This must be your slope. Okay, so that's your b. We don't usually write it like that, but it looks, the tendency is to, because this is longer, it comes after anyway. So what is this called in the brackets? This is called the market. So we talked about calculating the market risk premium, and there it is. We're going to use it. Well, we were calculating the risk premium of different asset classes. This is particularly the market risk premium because it's the expected return on the market portfolio minus the risk-free. So that's called the market risk premium. And this is the capital asset pricing model. It's just a line. It's supported by a number of assumptions that I'm not going to test you on, even though I tested you last class on it, just to see that you guys looked into it. All of those options on that test were assumptions of the capital asset pricing model. None of them were false, just to let you know. So, lots of assumptions. And I already mentioned one of them about borrowing and lending at the risk-free rate. That makes this relationship possible. Now, it's called a pricing model. What does it say? It says that knowing that investors will choose the baseline return of the risk-free rate, because if they have disposable income, at least this will beat inflation on average. So they'll invest in that. So to be incentivized to take on risk, they must be compensated. How much will they be compensated? They're going to be compensated by the market risk premium for every unit of risk as measured by beta. Okay, so this is going to, for every unit of risk, if this is just one, they get an adjustment that's the market risk premium. So it's giving them that average premium. 1 minute. I have to charge my computer. I'm back. Sorry about that. Okay. And I improved my microphone quality, I think. Okay, so why is it a pricing model? Does anybody know why it's a pricing model? Are there any prices here? When it comes to stock and valuation of stock, what is the original model that we learn? We learn about the assumption that a corporation can exist forever. So it's a perpetuity formula where we get our dividend. If the dividend is level, so that's an assumption, then we can price the stock like that. Now we've evolved, we've become more sophisticated. Rather than just one interest rate, we're going to be more specific about where it came from. As given, we're going to calculate it and we're going to call it ERI. So for this security, that's the expected return. And sometimes I refer to this as ERI, and sometimes I call it R, you know, RI, whatever the company is, like RABC stock or something like that. And sometimes they just put an I in there. Okay, so all those symbols are referring to the fact that they're the interest rate or the required rate of return for that firm, investors in that firm, and otherwise the cost of capital of that firm that's used to determine if investments are viable, if they should take projects or not. Okay, so that's what I promised I was going to teach you about. So with this in mind, if I have the expected return, I have the price. So the risk-free rate is here. So that's the T-bill. This is the market portfolio. What is the risk associated, level of risk associated with the T-bill? What's the beta of the T-bill? What does beta mean? So let's see, what does beta mean? Let's remember way back, it's just the slope relationship between, remember beta is the relationship between a stock's returns and the market portfolio returns. So it's defined as beta is the sensitivity, beta I. Sensitivity of stock I's returns to market returns. Okay, remember way back, that's what we described as a special slope, where the x-axis is the market returns and the y is the stock returns. So I had here market and BCE or something like that, some stock. I can just say stock company. Okay, so let's talk about the sensitivity of T-bills returns to market returns. Well, T-bills are risk-free. There is no relationship between the returns on T-bills and the risky assets, right? There's no relationship. In fact, the beta would be 0. Oops. Similarly, the beta between, sorry, the correlation of the T-bills with market returns is 0. Okay, so that positions it there. The market portfolio has a beta of 1 because the sensitivity of the market portfolio returns to market returns is 1 to 1, right? That's going to be 1. And then in between here, we have all possible combinations of what? Of riskless T-bills and the risky market portfolio. In between here, we're mixing by purchasing or loaning money through T-bills. And over here, beyond M, we are short selling T-bills and investing in the market portfolio with the proceeds. This line can extend all the way back. On this line are all stocks and bonds and investment opportunities. In other words, no assets in efficient markets, no assets exist off the line. So let's talk about asset J. Let's say there's an asset J. If that exists in any moment, sorry, I'm having problems with my contacts. If an asset like J exists, we can describe its adjustment to the security market line. The way that we do that for this level of risk, so we'll call it beta J. For this level of risk, investors holding J will get this expected return. But everybody else, and all the other investors know that if they have this level of risk, they can create this portfolio to achieve this level of return. How can they achieve that? We just learned that they can short sell T-bills and put the proceeds towards the market portfolio to be here. Realizing that, investors holding J will want to get rid of J. How are they going to get rid of J if everyone can do the same calculations and realize that J is currently, maybe do it a little bit bolder. All the assets like J below the line would be overvalued. The price is currently higher than it's worth. Because what's going to happen is people holding J will look for people willing to buy J, and they'll incentivize them by offering lower and lower prices. So this effectively, I'll do it in red, lowers the price to keep dividends constant. This will force a higher expected return. And that adjustment to the security market line will be like that, right to here. So this will adjust and put us here. So you have people holding J will sell it. People that they identify willing to buy it will buy it for increasingly lower prices. And this all happens instantaneously as the price falls, the expected return rises and puts us here. Securities under the line are therefore overvalued and they experience a price adjustment. What about, do you have any questions with that? What about security K above the line? For that level, oops. For that level of risk, so let's say there's investors with that level of risk expect this level of return. So if investors are here and they suddenly find out about K because we assume that information is free and available and everyone has it, and they're aware of K existing instantaneously, what will happen? Why would they stay in this position where it is either some other stock that they're invested in that's positioned here, or a mix of the risk-free and the market portfolio to put them here? They'd rather have K. So how are they going to get K when people holding K are very happy to have K, right? They have to incentivize them by offering them higher price. So they're going to increasingly offer a higher price, and this will happen in reverse. So let's as the price offerings increase, simultaneously, the expected return must rise to keep this dividend constant. So that's a price adjustment of K to the security market line, and this all happens instantaneously. And so securities above the security market line are currently undervalued. Undervalued securities will experience a price increase. What should investors do when they are aware of a undervalued or identify undervalued security? They should long it, buy it and hold it. Let's see. Long, we talked about this before, right? So long is buy and hold it until they realize that price increase. And what should investors do when they identify an overvalued security? When they identify a overvalued security, they should short it. They should borrow it, use the proceeds towards their investments in the meantime, and then sell the security at the end of the contract or arrangement. Sorry, they have to purchase the security at the end of arrangement to return it to the broker. When they purchase the security, the price will have dropped, and in the interim, they've realized a profit. Okay, so that describes the security market line, how it emerges that all securities will eventually end up or instantaneously end up on the line. And all of this being held up by this capital asset pricing model and the assumptions, in particular, borrowing and lending existing at the risk-free rate, and there's no other interest rate like there's like no other bank arrangements you can make or anything like that. Okay, there's just the private sector, there's a risk-free rate from the government, and this ability to borrow and lend at the risk-free rate. The last thing I have to say about this is how do we end up somewhere here? To end up here, the beta of the assets that fall on the line back here are going to be negative. What assets have a negative beta? What does that mean? Negative beta. Let's go back again to beta. What is beta? Beta is the sensitivity of a stock's returns to the market return. So if the sensitivity of stock returns to market returns are negative, it means when the stock market does well, this asset has negative returns, or when the stock market does poorly, this asset has positive returns. So what assets, what sectors will be negatively correlated with the stock market? Does anybody know? Have an idea? Are you guys listening? Historically, in times of crisis, in times of war and uncertainty, investors turn to precious metals. Precious metals has been historically a store of value, and even to this day. And so historically, or on average, we find that corporations that deal in precious metals, so gold and silver, platinum, that the sector, so what does that involve? That involves extraction or mining companies. It involves exchanges. It could involve so that you can get a you can purchase a security such as an exchange traded fund in precious metals. Okay, you can have firms or companies that store precious metals and deliver precious metals. So investing a, in a in like a mutual fund or an ETF of precious metals involves investing in those sorts of companies, and those would have a negative beta. They could. In the age of cryptocurrency, things have been a little different. So during COVID, you would have expected precious metals to increase in value, but they didn't, but they are now. Gold experienced um, one of the, I think, one of the best valuations or increases in value in the last 25 years, just last year, or this past year. So, and you guys may have seen what's happening with Bitcoin right now too. So there's some corrections happening. But anyway, historically, and that's what I teach you, right? I teach you about foundations of finance. You expect precious metals to be a sector where the beta is negative. All right, so that's that. Any questions about this? So I have many problem sets where you have to answer questions about this. So it involves using the security market line to price securities and check also if they're under or overvalued. So if you want, we can do questions like that. So then I have some exercises, just you learning about the line, and you guys can watch the videos I have on that and practice these if you need to. Right now, I'm going to go to the last set of notes. Let me take just a quick pause here. I'm going to grab the last set of notes, and you guys can think about if you have any questions. The last set of notes is this one called cost of equity. This is an example. It's just I spend most of the set of notes discussing the UR case again, but this is UR case part 2, where we derive the required rate of return for UR. If you remember UR, that's the airplane case. I give you a bunch of data, and we're going to derive the expected return for it. Okay, so let's go there. The required rate of return for UR. Okay, so I've given you in the in Moodle, you have been given a sheet, a document that's called Your Case Part 2, and that's where I'm getting all this information from that I'm going to project now. Okay, so this is where you see I start switching from expected return that looks like this to just calling with the capitals, but then I start just using the small letter, lowercase letter. Okay, so what we're going to do is gather the information from UAir and determine its required rate of return. If you recall or you look back in your notes, what was the required rate of return that I gave you to determine whether we would accept the UAir project? What was the required rate of return that I used? If you go back and look in Unit 4, it was 10%. Can you guys see me writing? Please give me some feedback. Can you see my pen? Anyone there? Sebastian, you see my marker? Let me see if I can. It looks like you can't see. You see the projection, right? Let me try and project.
Yes, we see the projection, but I can't see like the pen.
Yeah, okay. But you didn't see the pen before or just now?
Just now.
Okay. You see this? No? Okay.
No.
Okay, I'm gonna just what I'm gonna do is just unplug it and do it again. Let's do it again. Oh no, I know why. Wait a second, I know why. That's why. Okay, here. Now it's gonna work. There you go. Okay, so in Unit 4, UAir's required rate of return was 10%. let's check. Let's use the capital asset pricing model and check how good that was. So here's the model. I just used lowercase, but it's the same thing. The expected return should be a markup above the risk-free rate, adjusting for every unit of risk as measured by the beta. Remember beta? What is beta? Beta is this is the formula. Beta is equal to RSYSX. Remember? And then we also found out that this was XY over the variance, something like that. So anyway, there were two different formulas. I don't think I ever wrote it like that, so I don't want to be confusing. But basically, it's just the slope, right? Let me just erase this. It was the slope of, remember, it was the slope of having the market returns here and the stock returns here. We're going to use UR this time. And looking at all the data, like the examples that we did to make calculations always had a line, but that's not necessarily the case. The data might look something like that. So we have that information, the market returns and the stock returns. I give it to you here. Here's the market, here's the stock. Put it in your calculator and tell me what's the slope. Give you a minute to do it. Just be careful with the negatives here. And use decimals because it's a good habit. Just be careful. This is 0.0491, etc. These are all percentages here. This slide got a little bit compromised. So try that and let me know what you get. See if I can do it at the same time. So I'm going to go to second data, make sure it's empty, and put in X is always this market and Y is the stock. And 0.0491 enter down, 0.1 enter down, 1579 enter down, 0.3 enter down, 0.0549 enter down, 0.1 enter down, 0.37 negative enter down, 0.55 negative enter down, 0.2646 enter down. Hopefully I did this right. Enter down. 0.1506 enter down and 0.3 enter down and ask for second stat linear. There's 6 observations. Yes. Then that is the mean of the market, the mean of standard deviation of the market, and the population standard deviation. Then UAR's mean, standard deviation. Where am I going? Right? A, and there it is. Okay, that's it. So the beta is 1.55. It's the slope. Let's see what I wrote here. So I did a bunch of handwritten calculations, which you guys should know how to do, but you don't have to do them because the answer is one. Oh, I have a little bit different number here. Maybe I entered something wrong or because of the rounding. Okay, let's just stick with we will stick with what I have here. Let me just double check them now. I'm curious. Did I enter anything wrong? Oh, we're going to do that. Did I enter anything wrong? Oh, 49. Oh, 1579.3. Wait, oh, 549. Negative. 5 negative. 0.2646. Yeah, there's an issue, I think, with the rounding. So here I didn't round anything, and I got a little bit different number. But anyway, 1.55. Oops, what happened to my 1.552 if you round it. Okay. Okay, so that is my beta. All right, so there's some issues here with what I did. So this is just an application. There's nothing new here. It's an application of what we learned. The model, calculating statistics. It's all the same. It's just an application. And the assumption the assumption I've made is that going to the Bahamas, because we're testing the Bahamas project, right? We're assuming that the Bahamas returns will be the same as UAir's returns. Now, it's a special project. It might not be exactly the same as UAir's returns, but we've used the data we had. Bahamas is new, so this is like the first easy thing to do, right? First attempt. So what else do we need for our model? We need, let's copy it here. So we have beta. What else do we need then? We have the risk free, do we? Oh, well, I don't have it yet. Let's see. Let's take it. So I have this. I'm assuming it's good enough. And can you guys see everything? Because it looks like it's being blocked by the participants on my end. Okay, so then you have this. You have the market, right? If we go back, the expected return of the market is this one. So we calculated that already with our calculator. So we have that one. Now we got to get the T-bills. So there's also information on that document for T-bills. Here it is. Remember when we were working with years ago, which is fine. I took a bunch of years here and I'm trying to calculate the T-bill rate over a neighboring time period. So 2005 to 2010. So I use this data and I just get the average. That's one way to do it. So this is the average T-bill rate. You can put them in your calculator and get the average, 2.365. And with the average of the market return, 5.11 that I just showed you, you could calculate an estimate of what's the average historical market risk premium. Aha. So see, I showed you the formula, but like how would you do this? How would you calculate this in practical terms? Well, let's look for the average historical. So you got to go over time using the averages. So I need the average of both, subtract them, and I get this number. It's not really a lot of history here. It's just like 6 years. And it's 6 years over like near in and around this horrible time period with the financial crisis here. So it becomes a question of what should I be using that data? Should I use more historical data? I do have a lot of data. If anything, you have lots of financial data. So maybe we're going to question that. But first, let's finish making this calculation. So what does it involve? We need the risk-free, which we got here, 2.365, but using the same thinking of, the questioning that I've just been doing, is this the appropriate one to use, or during this kind of volatile time, should I use like today's T-bill rate? That's what I'm going to do. I'm going to use today's T-bill rate, which is different than 2.365. It's the current T-bill rate is 1%. So I'm going to use the current T-bill rate. Going to use the beta that I calculated. And for this, the market risk premium, I'm actually going to use not the 1%, the current T-bill. I'm going to use the average T-bill. Okay, so make some notes about how I did this, which is not noted in any of these symbols. Okay, so this one was the current, and this one was historical average. And I get this number for the required rate of return of 5%. So what do you think about that? What is it that we use for UAIR? In the case, we use a 10% required rate of return for UAIR. But I just estimated that it should be 5%. So what's the consequence of picking a smaller one? Well, before we accepted the UAIR project, right? Are we still going to accept the UAIR project? Yes, we are. As long as the required return is smaller, we will continue to accept the UAIR project. So what I do is I'm going to look at that in a moment. But before I do that, I'm going to look at an alternative way of doing this, calculating the T-bill rate using more data. Let's use more data and see if it changes things too much. So remember we talked about the art of valuation, right? It's all what you put in determines what you get out. So garbage in, garbage out. If you have bad estimates that you're putting inside a model, you're going to have meaningless results. So I'm going to do this a few different ways, and just build a sense of like some choice, some options. So I'm going to use more data. I'm going to use all this data that we had for the risk and return notes. And there the T-bill rate was 3.7%. And the average return on common stock was 11.3%. And with this data, okay, this is much higher. So the risk premium is much higher. So over this period, it was much smaller at 2.75%. Now it's 7.6. So that's going to change things. I'm still going to go with the same current T-bill, 1%. And then this adjusts, and look how high this is now. So now we have a completely different result. So if we pick this one, our decision would change, right? We would have rejected the UAIR case because at 10% it was not rejected. But what was using the IRR, what was the threshold? Remember the IRR was, if you go back, was 10 point, geez, was it 10.6 or 10.26? Now I can't remember. I have to look back. So I better go back and look. Remember you. It means I have to go into unit 4 notes to see what the IRR was. Are you guys with me? Are you there? Wave your hand. Show me your face. Lecture notes, lecture notes. I actually don't have it in the notes. I have it in the explanation. I think it's 10.26. If you remember back, let's put it up. So this was the EUR case here. So if we take these cash flows, we can find the IRR, right? These are the total project cash flows at the bottom. Let's do that. If I put those in to my CF keys, clear work, 41600, enter down. What was a negative? 5028, 11600. Oops. 11600. 15. So this is what you guys have to remember. It all comes together now. Uh-oh, something happened to my, I don't know what happened. One more time. 41600. Negative, enter down. 5028. 11600. 5360. And 23700. And then IRR compute. Yeah, 10.26. Okay, so you guys can check that for yourselves. That is 10.26. Try and remember how to do that. You should know how to do that. Okay. So IRR was 10.26. And this is 12. So IRR, remember, it tells you the break-even return on the project. So what we do is we compare that to required rate of return. Yeah. And so this is the return on the project, which is better than the required, so we accept the project. But what if the required is 12? If the required is 12, we have a decision to reject the project. Okay, we have a decision to reject the project. So we're not going to go for that estimate. We're not going to use all the historical data because this is a kind of a different time. So what is the conclusion I make here is this is a very different result with this is a different answer with a different result. You're going to choose to reject the UAR in this case. So when these are different, okay, the convention is to use the more current data for a robust or more reliable estimate of the cost of equity. So we're calling it the cost of equity or cost of capital in general, but it's the cost of equity because right now we're just dealing with the firm as though it is a firm that issues stock only. I haven't spoken anything about debt or that it issues bonds, right? It's just a stock holding firm. And And so that's what we're going to do. We're not going to use this one, although we are able to calculate it. We're going to opt for this one, except before we do that, we're going to do one more estimate of the required rate of return. And that estimate is going to be made using the dividend growth model. The dividend growth model, I went too far, requires some information. So you're given this information on dividends over the last 7 years. 1, 2, 3, 4, 5, 6, 7. We're going to estimate for 2012, the next one, and calculate the price. Well, sorry, we have the price today. That's given as well. So just to be clear, so 2011 is today, and 2012 is next period. Okay, and the dividend growth model uses this form with the dividend next period, the original price, today's price, and the growth inherent. So we have to get all this information. So this is an application of the dividend growth model, which you should have practiced, but if you didn't, you need first to get, let's first get G. How do we get G? From this data, we can solve for G by using the first dividend from 6 years ago, or five, wait, 1, 2, 3, 4, 5, 6. So from 6 years before 2005 to today, 2011, you put the numbers in and you solve for G. So mathematically, G, if you want to assume, even though it's not the same every period, we're going to force an estimate of the average growth of dividends during that time, and it's about 3.8% to almost 4%. Now, using that and the last dividend, we can determine, and the assumptions inherent, we can determine the next period's dividend as 25, almost 26 cents. So with that number and all the decimals, because people buy more than one share, and the current price, we can put that in, the dividend, the growth we estimated, and we calculate the required rate of return like this. So this is our final result. You should practice making those calculations. Now this is reassuring because this is close to the required rate of return that we got for CAPM that we want to use of 5.273. So that's reassuring. We're going to stay with the CAPM estimate, but we feel reassured by the dividend growth model that with the assumption that growth will be at a constant rate, this is reassuring that that's a good estimate. Okay, so now let's apply it. To apply it, now I'm going to just whiz through, like fly through these slides because really you guys can check all this. So this was the data that I just showed you, the total project cash flows for UAir, and using this discount rate, we know we're going to accept the project, right? Because this is not a high hurdle to achieve. If we accept it at 10%, we're going to accept it at less of a requirement. So this one will be also accepted. The NPV will be $6,000. But if we had used the CAPM with the historical calculation of the market risk premium, then we would have rejected the project because this is too high a required rate of return. 10.26 does not beat that. All right. And I just show you here, I can map this and it demonstrates that this would be the SML where I put the risk-free rate at 1%, which we calculate, or we use the current T-bill rate, and we could draw the SML. And remember, on the SML are all feasible, or sorry, all efficient decisions, right? So you have all securities, all bonds and stocks, and all investment opportunities up here. And now the UAIR ends up here. And what did we say about assets that are above the line? They are undervalued and they should be purchased or invested in, right? Because they are going to go up in value. All right, so there's the expected return. So this is just in a drawing of the SML and our decision to pursue the Bahamas project for UAIR. All right, so it's okay. Well, I guess I have to stop. So we're going to pick up here and talk about the last few slides is to introduce debt as a firm that's leveraged. So a firm that has both equity and debt requires us to calculate the weighted average cost of capital, which you guys should have learned this in 3106. So it could be reviews for some of you. If it's not, then you're learning it now. And please do the exercises and prepare for next class. I'll see you on Wednesday, and I'll be in touch about picking up the assignments and about the exam on Friday location. Have a good afternoon. I'll post this video up if you want to see it, but you probably have enough videos to watch, so just watch those because it's just a repetition of what's on those other ones. Bye.
You have a great weekend,
Thanks,
Professor.
Sebastian. Thanks for communicating.
Of course.
Bye.